Hi, this is Randy Finney with the right side of the chart, and this is a mid to latish session update for Friday, April 25th, 2025. It's 1:45 p.m., so we've got another 2 hours, 15 minutes to go in the trading session. Just want to get one out to you. We had a little back test after the breakdowns. This is that 15-minute bearish rising wedge I gave you yesterday on QQQ. Remember, that's not just about this. There's a mountain of significant resistance overhead, and we're heading into a weekend after one of the biggest rallies in months. And I would, I bet it pretty hard. We're going to have a nice fade today. I wouldn't be surprised. In fact, I expect a red close or close to it, at least a fade of most, if not all, of today's gains. That's my guess. It's been a resilient bid lately in the last few days. Again, we've caught 80% of it, whatever, going long on the trend lines. I'll get to that in 1 second on the bottom of the triangles. And so here's the breakout. So I gave you today. We had the breakout, and I was counting it down, but we didn't take out that where was it? The BOD of support I gave you. Hold on one. This one right here, BOD support at 464.80. BOD means benefit of the doubt. It's a term I make up when you have two levels in close proximity. You had the trend line break right there. That was the red candle break. And that was the BOD below it. I added one more level since then. But that level, and I expected it to get taken out today. So right now, all you have simply, sometimes you break down and you don't look back. And quite often you break down, you'll go and back test the trend line and then go down. So that should be it right now. I would figure that's the high of the day. This rally's carried up pretty well. I've been watching a lot of metrics today, including volume. So far, we're on track, one of the lowest volume days in weeks, if not months, meaning there's no conviction on the buying today at all. It seems to me like the last flurry of short covering. And remember SPY as well. You got to see them both break down. This is that 15-minute chart of SPY. We broke down there, but held that BOD support right there, and went up, made a marginal new, and still very much divergent high. Again, on the 15-minute chart, we look at the 60s. This is SPY, the S&P 500 tracking ETF, just a hair above its downtrend line, its comparable downtrend line. If you recall the other day, I said QQQ could go on to pop above the trend line, but then SPY, you have two different subsets of traders, the S&P 500 traders, that's ES, the futures, SPY, or any of the derivatives thereof. And then you have your NASDAQ 100 traders. Of course, you have small cap trader, mid cap, all different indexes, but these are the popular ones. And so that's it. When you look at it from this perspective, we're just a hair above that trend line there, and negative divergence, at least on the PPO there. Let's look at QQQ. Again, QQQ took out and broke out and back tested, but this is what I had talked about the other day. So where you have QQQ breaking out, you also have it still in the lower end of my bounce target zone. So I've made my thoughts clear. That's my point for long-term accounts. Start adding back, which I have today. I'll continue. If we go up again, we'll go up more. I'll be fully short if we get anywhere near the top, and if we get some evidence of reversal, my guess is going to come. Hopefully we get that red close today. I'm looking for. And you'll see, I think, a lot of profit taking into the close today. It should be a nice day trade for active traders. And again, it's an objective level. This is that bounce target zone on SPY, which today we just hit for the first time. Again, I gave you this recently right there in the purple box. And you can see we're right there today. And it would be really nice to see this breakout, this green candle, which is a breakout of the downtrend line. Again, I just showed it to you on the 60-minute chart. It'd be nice to see that fail, meaning we close down, the candle's green now. If we can close down red below the trend line, and as I often say, the redder the better. So let's see what happens today. There's your update on the equity markets. Not much else to add. Certainly time, I believe, an objective time to start adding back many of the things we're short. I mean, if you keep it simple, you short the NASDAQ 100. You get more bang for your buck than the S&P 500, but there's other things as well. Tesla, I gave you, turn off all the lines. I mean, I pointed it out. It was annotated in the chart today. This red line right here, that's the 200-day moving averages. So I actually showed you that gift on the annotations. Well, where's my arrow tool? Right here, that gift, but there was another gift right there. Once you took it out, so you clearly took out the 200 exponential, they bounced off, and this is why I have both lines. I talk about this often. Some traders like the 200 simple, some like the exponential. Therefore, I have them both on my chart. And sometimes you only get a rally to one or the other. What's nice now is they both come in close proximity. So if you took that short today, you shorted the rally to the 200 simple. Exponential. You have the 200 simple moving average, 200-day simple that is, right above it, and you can see like many tech-ish stocks, it just does a great job of defining trends. There was one little whipsaw, you got right back above it. And again, if you took it on faith, you would have bought back in long, covered your short. Again, this is not all I trade. It's just one thing to identify the trends. And when you go to the Qs, remember, let's big picture stuff. Lest any of you new to the site, if you don't know my trading style, it is getting in front of the herd, sometimes getting it a little early, started covering shorts and talking and going long here, and being adamant that the no more shorts, the risk reward to shorting was not favorable. The risk reward to being long was more favorable, more chance of an upside rally with an imminent abatement in the trade war rhetoric and everything else going on. And so that was it. So we, same thing here. It's time to start scaling back in short. Why? Because everybody's bullish right now. I haven't had the TV on today or yesterday. I'm sure Kramer and the minions on CNBC are all marching out the bull brigade. Brigade, and saying buy, buy, buy. And that's it. And especially with Alphabet's beat last night. Now, keep in mind, quarterly earnings, just like the economic data and all that, there's such a lag there. You had Alphabet report last night. Well, when a company reports a quarter, that's for the previous 3 months. However, there's a 1 month lag from the end of the quarter typically. So you're talking data that's up to 4 months old. And again, we all know that the companies, especially the big ones, they're not in the business. Alphabet's not a tech company. Apple's not a tech company or hardware company. They're in the business of managing earnings pretty much. That's their forte, if you will. Being able to, consistently come out and beat expectations. Sure, once in a while they'll miss, but that's not very common. And of course, the latest trend right now is the lack of visibility. A lot of companies coming out and not giving guidance because of the opaque outlook right now. And so anyway, I could sit here and ramble on and on all the fundamental reasons, but technicals are what we do here. First and foremost, I like to talk about the fundamentals, and there's Alphabet, and you're seeing already profit taken on that pop today. There's the post-earnings pop. We closed there yesterday. The earnings pop, those poor suckers that bought that pop so far have lost about half of it. And, this is one of many stocks, but if I turn off all the let's leave the lines on first. Like many, and one reason that we, recently gained the bounce is a lot of stuff fell to key support. Trendline support, I showed you the semis hit my sixth and final target, as well as their primary uptrend line. Lots of things did, and that's the reflexive bounce that, we were looking for. Now, the $1 million question is how much more does it have to go? And my trading style, and when I'm talking now back into swing trend trading mode, which I am, I'd rather start getting back in a little early to avoid missing a sudden turn. Let's just say we gap down tomorrow, Monday, and we gap way down, doesn't provide an objective entry. So my plan, has been consistent and will remain. I'll continue to scale in a lot of these stocks. You can see Alphabet well below this primary, this uptrend line. That's the larger, lower trend line. And then you turn off all the levels. And again, this is just a common theme here. We had in the last couple of years, we've had a couple bull markets and a couple bear markets, right? This was the end of a bull market in the beginning of 2022, end of 2021. The NASDAQ peaked in November. The S&P peaked right at the start of the year. And then that's when most stocks lost their 200-day moving averages. And it was very simple from then. You just had to short rallies back into it and then recognize when the 200s were regained, which they were here. And then the same thing in reverse. You buy pullbacks to the 200s, right? Pullbacks to the 200s. That was a whipsaw. I covered it back then at the time. There were a couple that shot through the 200s. The vast majority hit the 200s and or my, uptrend lines and my price targets, including and not limited to the indexes, QQQ, SPY. And so that's where an example where it wasn't even considered to me a whipsaw, because the majority of other market leading stocks and the indexes at the same time were hitting their 200-day moving averages and or key price support levels or uptrend lines. And so that was a reversal point pivot, kept the bull trend intact, and then clearly taken out there. And that's it. So again, I say this because I just know I've done this a very long time, and I know a lot of you are new. Some might follow me for a while. Most want to buy today. I want to sell. You probably started selling yesterday or even the day before, telling you, hey, we're at those trend lines, objective short entry on QQQ. We took it out, but it's again, bigger picture shows much more significant resistance overhead. And again, as I started the video, you have QQQ and SPY, and the S&P 500 by many is considered the stock market. QQQ is an index, but it's really the tech sector is what it is. You look at XLK, overlay a chart of QQQ, which I'll do right now, and you'll see a perfect correlation. That's because over half the components of the NASDAQ 100 are tech stocks, heavily weighted towards the Big Mag 7-8, which you'll control where both of these go. And even in QQQ, you don't have sectors like financials, and I don't think there's any or many utilities. So it's not nearly as diversified as the S&P 500. So again, it's just a better trading proxy, if you will, for the market. That's the way I look at it. And a long-term investment. When it's time, when this bear market's run its course, or even the next downtrend, and I game the next bear market bounce, unless I see something strong in the financials that makes me want to overweight the S&P 500, trade that in lieu of, I'll use QQQ again and NQ, the futures. So that's it. When we go through here, there's Apple. I'm just looking at the 200 stocks well below their 200-day moving averages. And remember, we already took out and backtested and got rejected off a lot of the 200s. We could certainly have, and again, that's why I have bounce target zones. My degree of confidence on exactly where we reverse isn't as precise as it was on the way down. On the way down, I gave you multiple levels to watch for, and kind of the all-in moments, break of the trading range right there. The failure, once we broke out, fell back into the trading range there. Rallies back to the 200s right there. So this one's just a little bit wider bounce target zone, and it wouldn't surprise me in the least to see us come up to the top. It's not my preferred scenario, and then anything much more than that, that's where I'll have to reassess what's going on. And look, I'm open I try to be open to all things. And like I said, I had a lot of key sectors, key stocks hit some pretty significant long-term uptrend lines, including but not limited to the SOX semiconductor sector ETF there. That's a secular bull market uptrend line was just hit. So we could have a multi-month rally here. And the thing is to adjust right now. As you know, lately I've been living in a combo of the world of the short-term charts, with those mean reversion trades and just trading the noise in the stock market lately. And then also lately more shifting back because we have once again come back up to those bounce target zones. Talking about the longer-term positions, objective add-ons there. Same thing holds true in reverse for the VIX. This is also a long-term trade with still another target up here, but we've been swinging it. We're long at the lows, T1, pull back into the target, the scale back in zone right there, hit the bottom up perfectly, went up, hit T2, and we're still at the top of the scale back in zone. So just like the stock market, we can go all the way down here with the stock market going up to its scale, QQQ and SPY to their scale back in zone, or if this is the kind of vicious bear market, and so far it has a lot of a signature of a powerful bear market with this initial leg down that we just recently completed. And so if that's the nature of this one, it's not going to make it easy on folks. It's not going to, it does have to. I will say one thing, and then I'll move on. We'll look at some other things. It has to convince the masses, the majority, that the worst is over, that the perma bulls that are bringing out are correct, and this buy is a good time to buy markets are going to a new high. There won't be a recession, or if there is, it's mild. It's already priced in. Blah blah blah. Whatever else there's some. And again, maybe they're right. One of us will prove to be right. One will prove to be proven to be wrong. I'm talking about those that are predicting a much deeper bear market like me, and those that are saying the worst is over and it's a good time to buy. Only time will tell. And again, I'm going to use the 15-minute charts, the 60-minute charts, the daily charts, and I'm not going to be short going to new highs in my long-term account. Absolutely not. I will be stopped out long before that happens. So as of now, I've been building into those positions, and I'm probably about halfway there where I want to be, with some dry powder. But again, I'd rather be pretty heavy early on and then have that dry powder to add down there, and then to be too light and miss a big turn. Let's just say it's hammered down on the market come Monday with a big gap down. Even as a futures trader, I can do nothing about it. Futures are going to stop trading tonight after the market closes, and they're not going to open again until Sunday evening. And so that's the one time of the week, really, other than the 1 hour a day closing gap, 5 to 6 p.m. That's the one time that I could get see a big gap in the futures that I might wish I had pre-positioned for, or likewise. And one thing I do too, guys, I tell you all the time, especially when volatility is high, I always go on my trading account light into the weekend. I don't bet it. Right now is not a time to bet a hard, long, or short either way, despite where I think we're going, despite the fact I think Monday will be a down day and next week will be a down week, most likely. But again, there's still a lot of stuff coming off that's still coming off very extreme oversold levels. So I wish I could tell you with a higher degree of confidence. And if that was the case, I'd be betting it a lot harder. But I just can't. All I can tell you is kind of where I think things are going and how I'll be playing it. All right. And so part of this, I didn't pull it up today, but I've covered it many times recently. The put to call ratio never spiked to extreme levels. We didn't see that fear. Sure, what I call the rhetoric sentiment indicators, that's the AA, II, bull, bear spread. In other words, what people say they do if they say they're bearish. A lot of folks said they were bearish recently, but the put to call ratio is what I call one of my favorite money where your mouth is indicators, because that shows where people have actually laid their bets, bullish or bearish, and that hasn't hit levels that indicate especially because we did enter bear market territory in the NASDAQ. It would be very atypical for that to be over and the market to go to new highs. But with that being said, we also have just a few trading days left in the month next week to see if my longest term indicators flip, because this is why I can't get too aggressively short or overly bearish right now. This is my favorite long-term indicator, one of them, the 20-month exponential moving average. And as of today, even with the reversal, even if we get a red close, we're still going to close above the 20-month exponential moving average. That means we're going to keep the bullish trend that we fired right here with that close above it. We're going to keep it intact for the month of April. I'm sorry, today. Now, with that being said, this is a monthly candle. Nothing, and I repeat, nothing counts on this candle until the next Wednesday's close. Wednesday's the last day of April. So if we get a close down there, and as I said, or like to say, the redder the better. Imagine that's not blue but red, and we close down there. That's kind of 401k type stuff. I told you a few weeks back, I think it was the day of or the day before the lows, I did a rare move into, pushed money, went long in the 401k account. My wife's account, I have SEP because I'm self-employed. And that you can't actively trade, but, we got a single day pop, and then I took half off there, and I took the other half off yet. No other one additional quarter, and I have one more quarter. I think I'm just going to take that out today. It's just not worth it. Again, it was, I can't remember which close. It was the day before. I think I told you right here. So it wasn't a full. You can't with a 401k unless you have the type you can trade in real time. You have mutual funds. You have to the end of day close. So it was somewhere in here that I mentioned that, and got a good 10% lift on those equity funds. And again, just the RR isn't that good. We can go to new highs and beyond. And yeah, the 401k indicator is still in positive territory, if you want to call that 20-month that. But again, there'll be plenty of time. I would be shocked if we just went like this. It's just so much overhead resistance. They're going to hit, the 200s. Tesla's hitting it today because it's first out of the gates. It's more volatile. It got beat down first. Then you have the QQQ. You have SPY. And it would be, again, just very atypical to just blast on through those like they're not even there. Maybe there's something in the works coming that I don't know fundamentally from Washington, whatever. I don't think things could get any better. The damage has been done, in my opinion, with what the current administration has done with the trade wars, which is uncertainty. The markets don't like uncertainty. And as predicted, Trump came back down. He cowed down. He cowed down on a lot. I told you the other day, I really suspect it's as if somebody, the powers that be walked him into a dark hidden room down somewhere in the bowels of the White House where the Illuminati spoke, and they said, "You need to stand down, son," because he immediately, on the same day, reversed course, or the White House leaked it first, and then he did softened up on tariffs and on the Powell talk. And Powell talk, he was pretty adamant all along, and then all of a sudden he comes out the next day, "Oh no, I'm not going to fire Powell." Well, he got checked. As big as his ego is, someone or some entity or whatever it was checked him. And that's where we are. That's the rally. That's the fundamental cause of the rally that was likely already priced in the charts, and that's it. So again, it's a big not sloppy. When I keep saying that, it's a relatively small range. The bounce target zone is only from top to bottom about. Again, if you count that 500 level, which you should, that'd be the max, is about 7%. On QQQ, 7% for a 50-something percent, call from a drop to the highs and low, 50-something percent, and then ultimately more than that after that bear market rally runs its course off T7, which is down here. Again, I've told you that before. We'll go into longer term charts, but this is where, if and when we get there and the charts confirm, we should have a really nice tradable, multi-month tradable rally. There's just not a lot of evidence other than that oversold reading I highlighted back here. And you do get, even in bear markets, you tend to get at least a bounce, but oversold can and often does become more oversold. So, usually bear markets are over once you've had a oversold reading followed by a higher oversold reading that's less oversold to give you that positive divergence, right? All right, the other stuff, no particular order. I'm just glancing over my other charts. Let's look at UNG. We finally got that breakout, threw it out a week or two ago, but we never took out the trend line. I gave you an aggressive entry at support with an alternative, a more conventional entry or add-on. Even with the aggressive, there was no reason to go full in until the trend line's breaking up. We took it out. It's not doing a whole lot yet, but somebody asked me, I think it was just yesterday, and I gave an update, updated chart on the futures NG. And I said, this will play out most likely if my crude short plays out. So I'm going to get to crude in a second because of that mostly inverse relationship. Again, it's not always day-to-day inverse, but typically when crude falls down, especially starts getting really low after it's been correcting for a while, then the wells start getting capped, and you see natural gas prices usually go up inversely because of that. So that's it. You almost have to squint to see it, but it is a breakout of the trend line. Yesterday, to whoever asked, I had pulled up, I queued in my platform, pulled up the July contract. The June has more volume right now. The previous contract I showed you when we entered that, as I mentioned, was the March contract, I believe it was. or April contract. Or was it the May contract? May contract. There's always a natural gas is tricky. It's like 1 month behind. Like the June contracts, you have to stop trading in May, and vice versa, or going forward like that. So that's it. It either plays out or it doesn't. And then of course crude oil will likely help that. And I wanted to update the crude trade for you, for those of you in it. So this one was shared. Well, I'm adding a line. I'm adding it right here. Why did I do that? I did it for a few reasons. Let me tighten it up. It's resistance that ideally, you don't always get what you want, but ideally crude CL should remain below. You have this spike high right there, and then more recently you have 3 high spike highs right there. So you have this little trading range. This is not mere coincidence. We're in this trading range. This is T1. I'll give you this trade idea here with a secondary entry on the break of the trend line. We broke that first one. We back tested. Maybe it was right here at resistance. Then we hit resistance again. Then we broke the wedge straight down to my first target. Bounced back to my first target. Bounced back to my first target. Remember, these targets are support levels. And support is support until unless broken. So the way this works is ideally now we go back down. Then we've already bounced on it enough. Crude could, if it wants, it can trade sideways for a while. But based on the scope of this pattern and my, look at my outlook for it, it should break down there, go down to T2, reaction most likely, and then hit T3. And if so, then that should hopefully give a tailwind to natural gas. And it's all about spreading your bets anyways. All right, I updated gold, silver, and GDX for you today, but I used the futures chart, but I've covered this. I covered this in yesterday's video. We had multiple sell signals that we've been waiting for. We had a bearish engulfing candlestick. That is a potential topping stick, which means it could indicate gives you the potential for a major trend change. You have, it hasn't happened yet, but a pending high-level bearish PPO crossover. That'll help to see the PPO crossover. That usually, means that at least the near-term trend has changed. You also had the island cluster top I have been looking for, with an island, 2 candles together separated by gaps on both sides. They tried to rally it up yesterday, but never took out the gap. So we're still everything's looking good there so far. And that's it. I think now you can just put another line here. I'm sure this will probably bring in some stops, some selling. I'm sure there's folks that bought the pullback in gold that wanted to get in and probably have their stops a little bit below that low from Wednesday right there. And so that should open the door for more downside. But that's it. Gold's had just a voracious bid lately. As I mentioned, you turn off all the lines. It's gone parabolic. It looks very indicative of at least a near-term buying climax. Could prove to be a longer-term buying climax. We'll see, or not. But it has all the makings of it. So sitting tight there. And then, of course, you're going to get more bang for your buck trading the miners. The miners are already down just in the last took 3 days to drop 10%, over 10%. It's a hot trade. But the miners tend to move more. What you had first was this little false breakdown. You had the wedge. Now, don't get me wrong. We shorted that. I only gave you, I believe, 1 target back then, so we hit it. We shorted that wedge break, hit my first target, went a little lower, then we hit that trend line right there. So that's still on the 60-minute chart for this new trade. That was the previous trade, successful. And this one is the uptrend line. So T1's right there. So go down, T2. And by the time we get to T3, it should come in. If we do, it should come in with a trend line. And then I have potential for deeper targets. Why? Again, for what I just said, the potential that we could have a buying climax in gold and see a lot more downside than many expect right now. I just toggled to the weekly chart, not even thinking about it, but unless the miners rally back up, they're going to print a bearish engulfing candle here on the weekly. That means this candle, the body of it, that's all that matters. The body, the fat part, engulfs the body of the previous candle. And that, again, is a potential topping stick. Just like I highlighted back here, the week of Friday, ending Friday, February 21st, bearish engulfing candles on the weekly charts of all the major indexes. All of them. Wilshire, small caps, mid caps, large caps, S&P, I think Dow, you name it, you got it. So let me see what gold looks like. Gold, yeah, gold would have to dump too hard. It's not going to put a bearish engulfing on the weekly today. But again, we already had some sell signals on the daily. Let's see what silver looks like. Silver's been underperforming. You know, gold recently is coming off new all-time highs. Silver's been lagging behind, and that's why it's not going down as much. Somebody asked, but I think today maybe we're playing catch up. Silver's down 1.77% today, and I gave you that wedge earlier. Yeah, this is it right here on silver futures, symbol SI. For those of you, if the contract's a little too rich for your blood, QI, I believe, is the smaller mini or micro. Trades on the same price levels, but just has a smaller multiplier. So breakdown, nothing impulsive yet, nothing big, but it's a breakdown, so that's it. And there's your first target, / support, second, third. If it gets ugly, we go down here. As far as stops go on this, it depends on your trading plan. If you are playing a potential top in gold and the miners, and you may be trading GDX, silver in lieu of gold, it's simple. You know, if your reason or your logic was the trio of sell signals, which again with the island cluster top, the bearish engulfing candle, and the trend line break, so three sell signals all right there, you know, in close proximity, then your stop is right there at max. Because if the bearish engulfing candle's taken out, then that's not a topping stick. You could have even a tighter stop. When you have island cluster tops, I usually set the stop at least in the middle of the candle, or the top. Again, depends where and if you're shorted. So your RR, you know, from again wherever, if and when you shorted, is minimal compared to the downside potential. Because if gold wants to come, here's a long-term trend line way down here. That's going to be a drop of 17%. And if we do that, then GDX will probably go down twice that or more, would be my guess, because GDX always moves in a multiplier of gold. There's no hard set formula. I'm just trying to see if I have a trend line here on the weekly. No. Oh, let me go to my main board, see what I have marked up already. Got that trend line there. Yeah, we'll see. Again, trading GDX is just like trading the VIX, where you can blindfold me, don't show me what the VIX is doing, just trade it off the stock market. If you have a breakdown in the stock market, like you did, for example, when QQQ broke the trading range right here, or the night that Trump came out to announce the tariffs, what he called Liberation Day, which is really Liquidation Day, right there. And that day I gave you what it's called lights out level. We took it out right after his speech, and that was so another, I can't remember if I was probably right here. And so my point is, if you take, if you know the market's going to do this once it breaks key support, which was predicted once this trading range broke to the downside, or that lights out level, that's when you go long the VIX, and the VIX surges when the market has those big sell-offs. So my point is, that's the same thing trading. What I'm trying to say is, never ever trade GDX without first and foremost charting gold, because one thing might happen. Maybe let's say you have a breakdown of support on GDX and then you short it, but at the same time gold pulls back to trend line support and bounces and rallies. Well, the breakdown in GDX is going to fail. Okay, guys, other than that, all those, I had several high-flying individual names out there, for long-term shorts, such as Carvana. We shorted that initially on earnings in anticipation right here of a breakdown, a bad earnings beat. And then right after it started playing out, I gave you both. I believe I had, short-term targets right there and longer-term targets. So in my opinion, it's also an objective time to start scaling back in. No, nothing hard in my opinion, but time to start taking some of these names, such as Carvana, which again went on from the little wedge breakdown, hit, danced on, bear flagged on my primary uptrend line, broke down, and we're still well below the primary. Again, this is a long-term uptrend line that comes off the December 2022 lows. We're well below it. And so this is appears to me the first leg down, counter trend bounce, like everything else. Got really oversold, and we're right back to resistance. I had that 235 there level before. We are coming off a divergent low, but you can see this trend indicator I have here, the purple line, which is just a hair below the 0 line on the PPO. That denotes the trend. The primary trend all along here was bullish. So this period you want to be long and strong. Across there, bearish. We had that correction right there. I think we even had a trade on it. And then boom, we're still below it now. So what happens is this PPO line, you want to use the white line, the 9 EMA, the last of the two to cross. It's also called the signal line because it'll filter out whipsaws. So we're back testing now. It's not unusual to see that rejected. Now, if we get the PPO, the signal line clearly crosses back above, we start popping these next resistance levels. Yeah, maybe something else is going on. Maybe that drop of into the recent lows, 50%. Maybe that's it. I will say it's back above its 200s, but there's other ones we've shorted too, covering everything. SMCI, we hit that on the downside. We've had so many trades on SMCI in the last year, long and short. It's a busy looking chart. This one will pick a direction after the rest of the FANGs report next week. And if they, they're going to give hopefully some more visibility to their AI spending. They build servers for, AI facilities, and they follow this one typically, NVIDIA, and nothing's changed. I gave you long-term targets on NVIDIA. We broke the primary trend line. We back tested just like the indexes today on the shorter term time frame where I started out in the 15-minute charts. Sometimes you break down and you don't look back, and quite often you break down and you back test, and then that's it. We zig down. We hit T1, which was already hit back here. We covered it then, and we covered everything recently here as well, right here. And so now, being that we've already hit it and cut through it twice, it opens the door the next leg down. It's still below its 200s. And so again, this one's not a hard entry here. That's why I didn't throw it out today, but I'm going to put a trend line here. Let's see what that looks like. So we're right on it. Let me clean it up a little bit. If we can have a hard reversal today, like I think, yes, they'll sell it in their close on the trend line. That'll be just an intraday break, but followed by a failure to get above that trend line. In other words, another reaction. So again, it's not a screaming level, and in fact, we're above it right now. So I cannot make an objective right now, an objective case to short. You can start scaling back into these things, but 113, the 113.50, the 200 simple, that's where it got rejected here. The 200, the 200 exponential moving average, the 200 simple, and then the downtrend line. That was our last swing short entry there on the backfill of the deep seat gap. So that was, good for, that's about a 38% drop. And again, but still shy of T2. That's because everything else, there were too many other reasons to, cover some shorts and go long recently. And but when I look at this, like so many stocks, it's in a bear trend. It's in a bear market. It's below the 200-day moving averages. Just like here, it was above the 200s, and you wanted to just buy pullbacks. Now you want to sell rallies. Let's wrap it up. I'm at 37 minutes. UUP still third day in a row. I think we're up right back into that trading range as predicted. The PPO is crawling up, poised to make a low level bullish crossover. There's a low level under the 0 line bullish crossover there. We had one right there. Again, the PPO helps you just see those. That's when the PPO histogram crosses. Somewhere I have it here. And so when you see these lines coming up, you can almost anticipate, you can see the cross coming because they're momentum indicators, shows the momentum's turning. So we had a bullish crossover here, followed by a rally, bullish crossover here. But this one has longer term bullish implications because we just snapped back into that trading range. Again, I'm looking at the low level, not all the crossovers. That's why I don't have the histogram up. You could put it up, certainly. But that's it. So anyway, so far so good. There's that 60-minute bullish falling wedge. It's not rocking, but if it does continue up next week, that would help our gold, GDX, and silver shorts. Otherwise, if it does this and goes down, especially if it takes those new lows, keeps going, burns through the divergences. Now we could have another run at the lows and still have the divergence here intact on the 60-minute chart. So I'm not overly concerned. This could take a while to play out, or it could play out pretty fast, a rally in the dollar, short covering rally. The faster and more powerful it is, the more likely the gold bugs are going to get the memo. Okay, so that's my take on gold and how it may play out. My guess is probably see that start to build momentum if we can get that next week. All right, let's just wrap it up here. I think this will be my last video for the day. Probably shut down soon, start enjoying the weekend. If I see anything big that stands out, I'll get one out to you guys. I'll try to catch up, see if I've missed any questions today before I shut down for the week. And if not, this has been Randy Finney with Right Side of the Chart. Have a great weekend.